Hello friends, how are you? I hope all of you are doing really good. Welcome back to the EFF Excellency batch. So I hope all of you are really enjoying this, and I promise you that all of you will really enjoy this journey of EFF Excellency batch, right? First of all those who are new to the channel, all those who are watching it for the first time, guys, please subscribe to the channel, because this is the only channel where you're getting the full regular courses absolutely free of cost, and the whole of education at a very nominal prices that you are getting, right? Just investment in the books. This as you can see on your screen, this is the KSJ handbooks that you will need along with this EFF batch, right? You can order it from the website. The website is given on your screen at the bottom, ksjteaching.org. Cost accounting, financial management, all the courses, these three courses are available in English as well as in Hindi. Okay, and also like the video, that is very important, because that serves as a motivation for us that yes, people are liking the content, we should be providing more and more to our students, right? Okay, let's see what we have done so far. We have discussed about the national income in the last lecture. We started with this particular chapter of national income accounting. So we studied about what is a national income. National income is the value of all the economic goods and services which are being produced within the domestic territory of a country in a particular year, which we call it as in an accounting year, or in any year under consideration, plus the net factor income from abroad. Then the net factor income had two components. One is the FIFA and another one is the FITA. Factor income from abroad and factor income to abroad. This we have already studied, right? Then meaning of national income accounting, then significance and usefulness, that why we are studying this, different concepts. Factors of production, very important topic, sir. Factors of production, very important topic. That what are the factors of production? The factors of production are the inputs which are being used in the production of goods and services. Okay, land, labor, capital, entrepreneurship. Without land, you cannot start a manufacturing unit. Without labor, can you manufacture the goods? No, sir. Without money, money is what? Capital that you are investing in the business. Can you start the business? No, sir. Entrepreneurship, obviously you need to hire the entrepreneurs, or you yourself can be the entrepreneurs, right? So all these things are the factors of production. After that, transfer payment, as I told you, that this is the one-way payment. One-way payment means the payment is being done to a person, but any goods or services, nothing is being received in return, right? Like the pension is being given by the government to the retired people. Clear? So these are the transfer payments. Now we are going to start with the very important part, that is the components of the national income. There are various components which constitute the national income, or which lead to national income, right? Which lead to the calculation of national income. There are various components. So the first component that we are going to start with is the gross domestic product at market price, right? So we are going to divide it into three parts. The first part is the gross part. First we call it as gross. Then the second is the domestic, and the third is market price, right? So these are the three important components when we are talking about GDP at MP. We call it as GDP at MP. So there are three important components. One is gross, one is domestic, third one is the market price. Now let's see what this has to say. He says the gross domestic product is a measure of the market value of all the final economic goods and services. Right? Now what is he trying to say? He says it is a measure of the market value. Market value means the value which you can fetch by selling a product in the market, right? What is the value of that product in the market? That is called as market value. So he says it is a measure of, when we are talking about gross domestic product, that is GDP, it is the market value of all the final economic goods and services. Final means that these are for the final consumption. These are for the final consumption. That means if you are manufacturing something, if you are manufacturing a product, then what is GDP? GDP is the market value of your finished product, right? It is the market value of your finished product, because obviously if you will go to the market, what you will sell? Will you sell your raw material? No, sir. We are going to sell our finished product in the market. So it is the market value of all the final economic goods and services. What is economic goods and services? I told you in the last lecture also. Economic goods and services means which have a value, right, which can be traded in the market, right? It is not, it is all those goods and services for which you are going to pay something, right? You are going to pay something. It is not for, like I told you in the last lecture also, if it is a gift, gift is not an economic good and services, okay? So without subtracting depreciation, why it is written without subtracting depreciation, sir? Because it is a gross concept. Now just try to understand one thing here about the gross concept. I'll just take 2 minutes to understand this thing. We have studied about trading and profit and loss account. Trading and profit and loss account, right? Isn't it? We have studied about this. We always take sales, closing stock, opening stock, right? Then we take purchases. Then we take other direct expenses. And then we calculate our gross profit. Sir, is depreciation excluded in this? Is depreciation, do we subtract depreciation from the gross profit? No. Then what we do? We say gross profit carried down. Then here we say gross profit brought down. Then we take depreciation and then we take net profit, right? That means this gross profit, when we are calculating the gross value, in that the depreciation is not excluded. That is what he is saying here. That is what we are saying here, that sir, without subtracting the depreciation produced within the domestic territory of a country during the given time period, right? Produced within the domestic territory of a country during the given time period. Now this is again very important. That is why this gross was used for depreciation, right? Market price, that your product must be having the market value, right? Then domestic means any production which is taking place within the domestic territory of a country, that will be included in the GDP. Irrespective of who is doing that production. Even if a foreign company is coming to your country, right, within the domestic territory, they are manufacturing some goods, it will be included in the GDP of our country, right? We'll take an example. So these are the three important things. This domestic is for within domestic territory, within domestic territory, right? So what I am saying, what is GDP? GDP is the market value. GDP at MP. GDP at MP is what? It is the market value of all the economic goods and services without subtracting depreciation, right? Without subtracting depreciation produced within the domestic territory of a country during the given time period. So we are calculating, obviously, when we discussed about national income also, the first thing that we say that it is in an accounting year. The first part is of a country in an accounting year. That means we are considering a particular period, right? Here also he says in a particular period we'll measure the market value of all economic goods, right, in a particular period. Then he says it is a flow measure of output per time period. That means in a particular time period, what is the output that you are manufacturing? That is the output of only current period will be considered. Whatever the period, what is meant by current period, sir? Whatever the period is under consideration, will take the output of only and only that period as the GDP. Right? If I want to measure the GDP of 1st of April to 30th of September, so I'll take the output of only those 6 months. Right? I'm not going to take the output of the remaining period. That is meant by a flow measure of output per time period. Then we say it includes the market value of the goods and services produced by foreign companies within the domestic territory. That's what I told you, right? For example, the goods produced by a company from USA in India will be included in the GDP of India. That if any country, if any person or in any company coming from outside manufacturing in India, it will be included in the GDP of India, because the GDP says it is the market value of all final economic goods and services produced within the domestic territory of a country, right? Doesn't matter who is manufacturing, irrespective of who is manufacturing. The most important thing is it should be domestic. Domestic means it should have been manufactured within the domestic territory of a country. That is why I told you that these three terms are important: gross, domestic and market price. Clear? So GDP at MP is a value added concept. What is value added concept, sir? Value added concept means that there is a value addition being done in the economy. When you are manufacturing a particular good or you are providing a service, what will help, sir? You will be selling that good, right? Ultimately, the money flow will be there. It is a value addition. You are adding something to the economy by manufacturing the goods or by providing the services. You are doing some value addition to the economy. So GDP at MP is a value added concept. Now, what is value added, sir? You have added value to something. You have added value to something. Now, what is the formula for GDP at MP? He says the value of output in the domestic territory. That means whatever you have manufactured within the domestic territory, the value of that we will be taking while calculating the GDP at MP. Right? This is what we have already understood, sir. Value of output in the domestic territory. But one thing important he has taken here, minus the value of intermediate consumption. Now, what is this? Be very careful with this thing. Important, sir. That is what is known as value added. That what is the value that you are adding to a particular thing. We'll try to understand now. He says value of output in domestic territory minus value of intermediate consumption. Why this value of intermediate consumption is being subtracted here? Just try to understand this thing. I'll come to this. Why the value of intermediate consumption is subtracted? See, this is the benefit of the book. If you will read it from the ICAI material, they have given it in the paragraph forms, right? You won't be able to link the topics. That is very difficult with the ICAI module, right? That is why I have given it in the proper format that you are able to understand the things. Now, why we are saying that the intermediate consumption should be subtracted? I say if the value of intermediate consumption is not subtracted, it will result in the double counting of the value, right? How it is going to be that? Let's try to understand with the help of an example. A Limited manufactures the cloth worth rupees 1000 and sold to B Limited. A Limited is a manufacturer. A Limited is a manufacturer who is manufacturing cloth, right? So what is a finished product for A Limited? Sir, for A Limited, the cloth that he has manufactured is a finished product, right? That is worth 1000 rupees. Now, will this 1000 rupees be added in the GDP? He is manufacturing within the domestic territory of a country. That is not an issue, right? And this 1000 is the market value. Now, tell me, from the A Limited perspective, will this 1000 be added in the gross domestic product of an economy? Definitely, sir. Right? Because this cloth is what? For A Limited, it is a finished good. And we say that the value of any finished good manufactured within the domestic territory of a country, and it is an economic good. It is an economic good because he will be selling the cloth, he will be getting the value for that. So this 1000, as soon as this A Limited has manufactured the cloth, this 1000 will be added in the GDP. Understood? Right, sir. Then he sold this cloth to B Limited. Now this 1000 is added to GDP as it is a final product for A Limited. We have discussed. Now he says, now B Limited manufactures a shirt. Now using this cloth, right? Using this cloth, the B Limited has manufactured a shirt using the cloth bought from A Limited. Market value of the shirt is 1500. Now, how this 1500 has been arrived at? 1000 is the cost of cloth and 500 is the profit. We are leaving the other aspects like labor, overheads aside, right? We are just taking it as an example that let's say B Limited manufactured a shirt and this shirt is being sold in the market for 1500 rupees, right? This shirt is being sold in the market for 1500 rupees. In that 1500, 1000 is the cost of the cloth that is purchased from A Limited and 500 is the profit, right? Now tell me what will be the GDP addition from the viewpoint of B Limited. Sir, GDP addition from shirt, who manufactured the shirt? From B Limited, will only be rupees 500. Why? Sir, because this 1000 cloth which has been used in the manufacturing of that shirt, this has already been added in the GDP when A Limited manufactured it, right? When A Limited manufactured it, this 1000 was already added in the GDP. Now, if you add 1500, the final product for B Limited is 1500, but if you add 1500, this includes 1000 as the cost of cloth and 500 profit. This 1000 will again be added in the GDP, which is absolutely wrong, right? This 1000 is what? This is your intermediate consumption. Right? Intermediate consumption means any product which is being consumed as a raw material for the manufacture of a final product, right? So that is an intermediate consumption. Now you understood that why this removal of intermediate consumption is important, right? Why we say that value of output in the domestic territory, that is 1500. Now from the B Limited point of view, it is 1500, that is the value of output. Right, that is the market value of the goods and services that he is manufacturing. It is the market value of the shirt minus the value of intermediate consumption minus 1000 rupees, the cloth that he has used as intermediate consumption. Intermediate consumption means that is not a final product for a final consumer, right? It is a raw material for some other factory. So minus the value of intermediate consumption, what we are getting is, what is the net value added in the economy? The net value added in the economy is 500 rupees. That is why this is known as, GDP is known as a value added concept. Clear? So I have tried to make it a very simple and memorable topic. Divided into three parts: gross, domestic and the market price. Right? So gross domestic product is what? It is a measure of the market price of all economic goods and services without subtracting depreciation. Why without subtracting depreciation? Because it is a gross concept, right? Produced within the domestic territory of a country during the given time period. As simple as that. Clear, sir? Good. Let's move on. Now it says what all things are excluded from the GDP. What all things we are not going to include in the GDP. Any value of non-economic activities. What is non-economic activities, sir? Gift can be there. Donation can be there. Right? Non-economic activities. Non-economic activities means where there is no purchase or sale of goods and services. Right? You are getting the goods but you are not paying for it. Clear? That is a non-economic activity. Gift is there, donation is there. All these are what? All these are non-economic activities. Transfer payments. Transfer payments we have already discussed. What is a transfer payment? Like pension to the pension by government to retired person, where there is a one-way flow. Okay. Then is the value of output produced by country's citizen and firms abroad. If a person from India manufactures goods in USA, will that be included in the GDP of India? Listen to it very carefully what I am asking. I am saying if a person from India, he is manufacturing the goods in USA, will that be included in the GDP of India? No, sir. That will not be included in the GDP of India. That will be included in the GDP of USA. That is what is here written here. Value of output produced by country's citizen. Countries means India, right? Indian citizen in USA. Will that be included in the GDP of India? Absolutely no. After that, value of transactions which cannot be expressed in the monetary terms. Obviously, sir, if you cannot express it in the monetary terms, then it is not possible to calculate that what is the value being added by that item, right? Okay, after that, value of illegal transactions. Sir, illegal transactions are never considered in any economy as a part, because illegal transactions are not adding to the value of that economy. isn't it? Illegal transaction, any kind of illegal transaction, let's say drugs. One person is selling the drugs, other is paying the money for that. You will say it is an economic activity, but is it a legal transaction? No, sir. It is an illegal transaction. Will that be adding to the GDP? No, sir. That will not be adding to the GDP of the economy. We will not consider any kind of an illegal transaction, right? So I hope this GDP concept is clear. What is gross domestic product at market price, right? Exclusions from GDP and why the value of intermediate consumption is being subtracted. Now, there are two more concepts in the GDP. One is nominal GDP and one is real GDP. Nominal GDP and real GDP. Now, what is nominal GDP? Nominal GDP is GDP calculated at the current market prices. Let's try to understand with the help of an example that will give you a better clarity. In the year 2011-12, right, we consider it as, we say it as a base year. Right, we say it as a base year. Now, in the base year, you manufactured 1 lakh units and the price per unit is 10 rupees. What is the GDP contribution? 1 lakh into 10, 10 lakh rupees is the GDP contribution, right? Because it is the market value of all the economic goods and services produced within the domestic territory of a country. So, you manufactured 1 lakh units within the domestic territory of a country and the price is 10 rupees per unit. So, what is the GDP contribution? That is 10 lakh rupees. Now, what happened in the year 2019-20? Right, let's say this is a current year. This is current year. In the current year, you manufactured 80,000 units and the price has increased to 20 rupees. What is the GDP contribution? That is 16 lakh. Now, what you will say from this? What can you interpret from this? You will say that, sir, our GDP has increased by 6 lakh rupees. That means our country is doing very good, isn't it? As a layman, we can say this. As a layman, we will say that the GDP of the country has increased by 6 lakh rupees. That means the country is doing fantastically well, right? Absolutely good, sir. But one thing you need to see here. Now, as a layman, we may say that the GDP has increased from 10 lakh to 16 lakh. However, if you see why GDP has increased, you need to understand why it has increased. Sir, is it due to the increase in the number of units? No, the number of units has decreased from 1 lakh to 80,000. Right? Is the country growing? Sir, you are manufacturing less number of units. Why you are manufacturing less number of units? Because that means there is a less demand for the product. So, is it good for the economy? No, sir. Why the GDP has increased? The GDP has increased due to the increase in the prices, right? That shows the inflation part. Sir, this is due to inflation. The prices have increased. The number of units have not increased. The economy is not growing. Economy is declining. Right? However, the number of units produced have declined. The increase in GDP is solely due to the increase in prices and not production. Right? So, the GDP, why the GDP has increased? The increase is solely due to increase in prices and not production. That means here we cannot say, therefore, the nominal GDP gives the misleading picture about increase in GDP without addition of goods manufactured. Right? Sir, you are not increasing the number of units. What has increased? The price has increased. That shows the inflation in the economy. Right? From 10 to 20 rupees, if your prices of the goods have increased from 10 to 20 rupees, that shows the inflation in economy. Inflation in economy. Right? 10 to 20 rupees, that shows inflation in economy. That means the GDP has not increased. Here the country is not growing. Here if we say the country is not growing, economy is not growing. Okay, country, I won't write it as country. I'll say the economy is not growing. Economy is not growing. Right? So this is nominal GDP. This is nominal GDP when we are calculating the GDP at the current market prices. We calculated at 20 rupees. Now, on the same lines, what is real GDP? We need to understand what is real GDP. Real GDP is real GDP is GDP calculated at the prices of the base year and not the current market prices, right? Real GDP is GDP calculated at the prices of the base year and not the current market prices. For example, in year 2011-12, that is the base year, goods manufactured 1 lakh unit, the price per unit is 10 rupees. What is the GDP contribution? 10 lakh. Now in the current year, now this 2019-20, this is your current year. You have manufactured 1,20,000 units. What is the price that you are going to take? The price you are going to take is of the base year. Now what is GDP contribution? 12 lakh. Now we can say that is the GDP has actually increased? Yes, sir. Yes. Now there is an actual increase in the GDP because we have kept the price constant, right? We are not changing the price. The price is 10 constant, sir. What we are increasing is the number of units. The GDP has increased due to the increase in the number of units and not due to the prices, right? So in the current year also, we are calculating the GDP using the price of the base year. So GDP increase. Now this 10 lakh to 12 lakh increase in the GDP of 2 lakh is due to increase in the number of units. Now we can say that economy is doing good. Economy is growing. Clear? So real GDP gives more realistic picture as the increase in GDP is attributed to the increase in the number of units manufactured and not increase in the prices. That the increase in the GDP is due to increase in the number of units and not the prices, right? If the GDP has increased due to only the increase in prices, that shows the inflation, and inflation not the sign of a growing economy, right? But here when we are keeping the prices constant, we are keeping the price of the base year and still the GDP is increasing, that increase is due to increase in the number of units, right? So in this case, GDP will change only when there is a change in the physical output. So that is very important. That means whenever you are focusing on the GDP, we need to see that why the GDP is changing. Is it due to the physical output or is it due to the price increase, right? So that was nominal GDP and the real GDP. This topic was not there. Nominal real GDP, I think, was not there earlier. Okay, the next topic is GDP deflator. What is a GDP deflator? GDP deflator is a relationship between nominal GDP and the real GDP to find out what is the inflation. GDP deflator is a price index used to convert the nominal GDP to real GDP. The GDP deflator measures the change in the prices that has occurred between the base year and the current year. That means he says, what is GDP deflator? He tries to understand that if we calculate as per the base year, then what is the GDP, right? We call it as real GDP. And if we calculate at the current prices, then what is the GDP? We call it as nominal GDP, right? So he tries to understand what is the relationship between. That shows the inflation part. Why? At the base year it was 10 rupees, at the current year it is 20 rupees. That means there is an inflation, right? What is the rate of that inflation? That is shown by GDP deflator. It measures the current level of prices relative to the level of prices in the base year. In 2019, if the nominal GDP based on current prices is 600 billion and the real GDP based on the base year prices is 3,500 billion, the GDP deflator is 171.43, right? 171.43. So this is how the GDP deflator is calculated. Nominal GDP divided by real GDP multiplied by 100. That what is the nominal GDP in relation to real GDP, right? Base year to be kept in the base, current year to be kept in the top, multiplied by 100. Since nominal GDP and real GDP must be same in the base year, obviously sir, nominal and real GDP in the base year will be same. Otherwise, we will not be able to make the comparisons. Here also, we have taken the base year price as 10. While calculating the nominal GDP also, we have taken the base year prices as 10. It should be same. Otherwise, the comparison will not be right? Using the GDP deflator, the inflation rate between the 2 consecutive years can be computed. That what is the GDP deflator in the year 2 minus GDP deflator in the year 1 divided by GDP deflator in the year 1. That is what I told you, that through GDP deflator, what we are trying to find out is the inflation in an economy. Inflation in an economy. That what is the GDP as per real GDP, what is nominal GDP, and the difference between the relationship between the two shows the percentage increase in the prices, because nominal GDP is due to the increase in prices, real is due to increase in the number of units. So in the real we are taking the base year price, in the nominal we are taking the current market price, right? So we try to find out what is the change that has occurred in the base year and the current year prices, that is inflation. Clear? That is shown by this GDP deflator. Okay, so in the next lecture we'll be doing some practical problems on the GDP deflator, right? On the real and nominal GDP, we have the ICAI MAT problems. 2-3 problems are there, illustrations are there. We will complete that and then we will move on to the next component. I hope this GDP at MP part is clear to you. Just go through it once, revise it very thoroughly, focus on the small things that we have done in this lecture, right? I hope you have enjoyed, and if you have enjoyed, do share with all your friends. And if you are watching it, guys, please grow this KSJ family on Instagram also. Follow us on Instagram, search for KSJ Teaching, right? All the links. And for handbooks, you can buy it from the website. All the links are available in the description of this video. For Financial Management English regular course, you can get it from our mobile app at very nominal charges. Mobile view, laptop view, both are available on the mobile app, right? So see you guys, see you in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.